Welcome to another video brought to you by Aswat, a specialist UK and international tax advisory firm. My name is Omar Aswat, Chartered Tax Advisor. And in this video, as you would have seen from the catchy thumbnail or from the title, we'll be discussing certain aspects around the less tax for landlords scandal. You could call it some sort of a scandal. There were other companies involved as part of this wider group, but this video is not about, talking about specific companies. In this video, we'll be discussing three particular aspects. So I only want to discuss three aspects from the scandal or from the promises that were promised to landlords. There were many other angles that I could have discussed. In this video, we'll discuss inheritance tax. So the promises made around inheritance tax and why they fail, around the mixed partnership rules, and finally, we'll touch upon the mortgage interest relief restrictions. As I say, other angles that could have been discussed, and maybe it's for another video. If I get enough comments, likes, shares, I'll discuss capital gains tax issues, stamp duty, land tax issues, and there are many other issues that can be discussed. But as I say, I wanted to keep this video a bit more specific and a bit more precise. Before we go on, don't forget to like, comment, share and subscribe to this channel, and feel free to reach out. We've had many landlords reach out that have been affected from such a scheme and they want to make things right. Okay, many of them feel conned, many of them feel deceived, and in many cases, rightly so. If we start with the first point, which is around inheritance tax. Now, in the Inheritance Tax Act 1984, there is specific legislation that allows for certain assets to be completely exempt, 100% exemption from inheritance tax, or 50% exemption from UK inheritance tax. Yes, there will be rules introduced from April 2026, but we're shooting this in Feb 2025, so we'll talk about the current rules. And one of the promises made to the clients of the less tax for landlords scheme was around inheritance tax. Effectively, magically, they were promised that their property portfolio, whether it's worth $1 million, 5 million, 20 million or 100 million, after 2 years of running the properties within their structure, so effectively you have an LLP, you have limited companies involved, you have different shareholders, different share classes, different partners within the partnership. That's for another video in terms of explaining the structure itself. It's been dismantled now by HMRC anyway, so probably not too much benefit there. But the point here is that they were promised that after 2 years of running the structure, their property portfolio would be completely free, 100% free from inheritance tax. Now, this is, it's quite bizarre if I'm being open and honest. It's bizarre because effectively what they're trying to do is argue that the investment portfolio, whether they're running a business or not, that's one thing. But they are arguing trading status for business property relief purposes under the Inheritance Tax Act 1984. Now, come on, if we're being open, anyone can dismantle that in a second, literally pushing boundaries to the max. You can't argue that it's a trading business. Okay, even in certain cases where somebody's running an Airbnb, where there's so much more trading activity, when you look at case law, those cases have been thrown out. As in, it's not been accepted that we have a trading business. Yes, it's 50-50 split, but ultimately property investment businesses are excluded, specifically excluded from business property relief. So effectively, let's be open about this. Less tax for landlords, those behind the scheme, they were looking to push the scheme, push boundaries as far as possible. I advised against it many a time. Why? Because it's just very obvious. Yes, I am a chartered tax advisor, but I'm pretty sure most would have actually known what is going on. So that's from an inheritance tax perspective. Let's move on to the mixed partnership rules. As part of the structure, you'd have, again, on a very high level, you'd have the LLP, again, trying to argue business activity. You'll have the LLP, and you'll have individual members or partners, and then you'll have a corporate partner, meaning the limited company, and that's where you have the share classes and certain other planning that was taking place. But ultimately, the LLP is transparent for tax purposes, so any profits or losses flow through to the members or the partners. What happens, and it still happens till today, it's just a matter of HMRC picking up on it or not. You have, let's just say, basic example, the LLP makes £100,000 in profits and it's owned 40, 20, so 40%, 40% and 20%, 40% and 40% by individual members and 20% by the corporate member. Effectively, what you do, instead of instead of distributing the profits in the 40, 20 split, you just distribute most of it. Let's just say, again, for example's sake, you distribute 100% of it to the corporate partner. Effectively, companies pay tax, corporation tax at 19 to 25%. Individuals will pay income tax between 40 and 45%. 20% as well. We're being a bit more realistic here. Now, what has happened there? The individual members, they have effectively eliminated their income tax and the company is paying tax but at a reduced corporation tax rate, and there are other planning strategies that can be explored in the corporate partner. When I was studying for my CTA exams over 7 years ago now, this was actually in the advanced technical OMB, owner managed business paper. We had a 20-mark question and the question was split into a 17-marker and a 3-marker, and the question related to the 3-marker, and these were the days before COVID, so we didn't have it wasn't open book like many have these days, the easy way. We could take the legislation in, so the big yellow toddies legislation that I would take in, and effectively the 3-mark question was talking about the mixed partnership rules, whereby it's very open, very straightforward, very blunt. Again, how they missed this angle, as I say, pushing boundaries, is very open that you can't transfer or divert profits to the corporate partner in excess of the percentage membership in the LLP, or in relation to the work, or in relation to the attribution into the LLP. So that's 2 angles we've covered off. Number 1 is inheritance tax, why that doesn't work. Very open, very straightforward. And number 2 is the legislation around the mixed partnership rules. Now, don't get me wrong, people still use these kind of structures and they're diverting excess profits to the corporate structure. And after that, it's just a matter of if and when HMRC pick up on such transactions. But it doesn't work. People still come to me asking me, can I do this? Can I do that? They think they found a beautiful and brilliant idea and they are very upset, and it's fair to say that I don't gain a new client once I have explained. And to be honest, I don't spend too much time explaining these days anyway. It's just does it work? Yes or no? No, it doesn't work. Finished. I'm not going to start explaining to every single individual the tax legislation. For me, it's more around, clients, they don't really want to know legislation. They just want to know that I know the legislation and I'm confident and content in what I am advising them. So those are 2 angles we've covered. And finally, we'll talk about the mortgage interest relief restrictions. Under Section 24, famously known as Section 24, the mortgage interest paid is not fully deductible as an expense for individuals, but it is for corporates and the LLP. So what Less Tax for Landlords were advising is that although the mortgage is legally, or the agreement is between the individuals and the mortgage provider, they would introduce a declaration of trust, and effectively it'd be the LLP paying the mortgage, and therefore the LLP was deducting the full amount, 100%, compared to what is actually allowed for individuals. And therefore, again, going around the rules, the declaration of trust, again, this is very questionable, but ultimately it doesn't work, and it didn't work from the start. Many were advising against it. I used to advise specifically against the inheritance tax position and the mixed partnership position. And I didn't, at that time, many years ago, I didn't spend too much time looking into capital gains tax and stamp duty land tax, but there are many issues there as well once you start looking into matters. I hope you found this video beneficial. I hope you found it useful. We have picked up a good few clients where they now want to make things right. Okay, so we're not the police. Okay, we're not going to judge anyone. We just want to help you make things right, and perhaps it's a matter of incorporating the right way, because many of you do have a business case. You are literally running a business, and we don't need to start talking about the Ramsey case and 20 hours, but you have many properties that are either in the LLP now or in your personal capacities. So we are helping clients incorporate the right way with, covering off every single piece of legislation, providing you that comfort, that confidence, that peace of mind that things have been done correctly this time round. And most of the time, or a lot of the time, it does make sense to incorporate into a limited company. Why? Because you have the rates of corporation tax that are cheaper. You can start to bring, so we don't just end there. We don't just do incorporation. We do a lot more after that. We look at SaaS pension funds. We look at how do we bring the next generation into the picture. We have alphabet shares, dividend tax planning. Then usually shares in a company are easier and smoother for inheritance tax planning. So then we're looking at things like growth and freezer shares, discretionary trusts, and all the other exotic stuff. You can be sure to be in safe hands. We are all chartered tax advisors, FCCA, ATT, and experienced, and also proactive in such transactions. I think it's important to be proactive as well, rather than just, when I say proactive, I mean like, we get things done, but also thinking outside the box and thinking what is bespoke to your particular circumstances. There might be children that have marital issues, for example, or you might be looking to move offshore. You might be looking to move to Dubai. Everyone's running to Dubai these days. I'm shooting this video in Saudi Arabia. So it just depends. It depends. And we prefer a bespoke and tailored approach to your circumstances. And that's why we don't work with anyone and everyone, but do reach out to us. Let's have that initial conversation. I'll be more than happy to have a chat. I genuinely believe myself, my team, we are very, without blowing our own trumpet too much, I think we're very good at what we do, and we're just getting better every day. We advise on high level transactions. My most recent case that we've just been engaged for, a 55 million property portfolio around the UK, and some international aspects such as back home. But ultimately, this is what we do. So don't forget to like, comment, share, and subscribe to our channel. And I hope to speak to you soon. Thank you. Bye.